Welcome back to Stuff About Money podcast. I am Erik Garcia, certified financial planner, your host for today. Now, I know some of you are probably wondering, where has Xavier been? Xavier hasn't been co-hosting with me for a little while. The summer has been a grind down here in New Orleans with scheduling and kids off of school and trying to schedule guests and having us both available at the same time. So he has been on break, but we are planning a handful of episodes where it's going to be the two of us. So for those of you who are looking for him, he will be back. Don't worry, he was not kicked off of the show. But today we have a guest. Ian Saunders is a senior research analyst over at Nasdaq Dorsey Wright. Nasdaq Dorsey Wright. It's a technical research firm, an investment firm, and he is going to join us today to talk a little bit about their investment philosophy. Lately, for some reason, I've just been I've been interested in looking at different investment philosophies from different investment firms, particularly as we're at this kind of transition in what we're seeing in the stock market, this transition in the economy. Where we're starting to see money rotate out of certain asset classes into new asset classes. So I've just been kind of digging into different investment philosophies and having these deeper conversations. So I'm glad that Ian is here today to join us. Ian, welcome, man. Tell us something interesting about yourself that would help us, I don't know a little bit more about you and your interests.
No, it's not. Thank you for having me on, and thank you for those listening. Something interesting about myself, I guess from a little bit of like historical perspective, I have only worked at Dorsey Wright historically, so technicals are all I know, I guess is something you could say.
So that's it. Like you were almost born at Dorsey, right? Not really, but
That's right. They came in, as soon as I came in the door, they locked the door and they wouldn't let me leave. That was the
yeah, no, your story is you were an intern there, right? You started interning while you were in school.
I was, yeah. So I started interning there while I was actually in high school, and then came out and kind of kept coming back throughout time. Did go to college, did graduate from college, thankfully, but kept coming back to Dorsey Wright, and got to see the firm go through a fair amount of changes. When I started off, we were not owned by Nasdaq. We were
Yeah.
we were just a small little research firm in Richmond, Virginia. We still feel like a small research firm a lot of the time now, but Nasdaq did acquire us back in 2015. So got to see some different aspects of different parts of the financial industry. It's been a pretty good ride so far.
Very cool, very cool. And you said technicals is all you know, and we're going to get into that as we talk about Nasdaq Dorsey Wright's investment philosophy and the investment philosophy that drives y'all's research over there. But before we jump into that, got a question for you. We ask this to all of our guests. What's something about money you know today that you wish you would have been taught in school? Now, this is interesting for someone who interned at an investment firm. So maybe you weren't taught in school, but you learned it early on. But the question still stands: what's something about money that you wish you would have known, that you know today, that you wish you would have known earlier?
Yeah, so something about money I know now that wouldn't have known earlier. So there's a lot of things that I've learned over the years that I wish I would have known when I was first starting, right? Something I didn't learn in school, I think to part of your question is, I think a lot of different educational environments around the country and around the globe they don't like teaching technicals. They teach a lot of fundamentals and they don't like teaching technicals most of the time. I wish I would have learned a little bit more about that before diving in, because you can kind of think of it as a little bit more of which one's right? Are the technicals right? Are the fundamentals
Yeah.
right? You can kind of get into that kind of combative atmosphere, which I don't think is healthy in analysis, right? You want to use both. You want to use both aspects and try to arrive at your most informed opinion. So I'd probably say, I mean, that's part of it. The other thing I would say
So
is,
before you go to the other thing, just so that some people are listening, they're like, "What in the world is Ian talking about? Technicals versus fundamentals?" Now, let's not get into the deep end of it because that's what we're going to talk about. But high level, what's technicals versus fundamentals?
so the fundamentals are going to be evaluating a company based upon its kind of communicated information with the market, right? What are its kind of price to earnings ratio? How are its sales doing? Is it selling more goods or not, right? Whereas the technical side of the coin, the fundamental side is pretty good at identifying like what's a good company? Is this
Mhm.
business doing well, right? The technical side doesn't really care about the business. It cares about how the stock's doing. So
Yeah. Okay.
independent of the business itself, how is the stock doing? Is that price going up? Is that price going down? That's what it comes down to at the end of the day for technicals.
Okay. Okay. So
And so
fundamentals looks more like the quality of the company, where technicals doesn't care if it's a good company or not. Just, hey, or is there a chance to make money in this company based off of what's happening with the stock price?
exactly. And we see
Okay.
countless
Yeah.
examples of something might be a great company, but for whatever reason, it's not a good stock. The
Yeah.
investment's not going up over time, right?
And we're going to talk more about that, because technicals, a particular type of technicals is what y'all do there and specialize. So we'll get into that. But what's the second thing you were going to say about?
Yeah, no, it kind of piggybacks on the first. So I think the technical side, kind of learning a little bit more about that. But once I got that understanding of the technical side of the coin, as I mentioned, all this comes to like a competitive environment, and I don't think that's healthy in analysis. You want to kind of use all the information available. So
Okay.
learning not to disregard other information just because I don't agree with it, I think would have been a pretty important thing to have a better mindset on earlier on.
Yeah, that's really interesting. In that, I like how you say that it's not either or. Sometimes it's both and. I think that one can inform the other, and vice versa. Technical analysis and fundamental analysis can inform each other.
And just different people's opinions, right? I mean, some people might not share the same opinion about a fundamental or technical aspect,
That's
and
right.
learning what other people think. So you can either inform your opinion better or argue your opinion better. Can go either way.
Yeah, and I find this not just in investing, but in many things in life, is that when we interject an opposing view, it sharpens our view, makes our view better, makes our opinion maybe changes, right? Maybe we evolve a little bit in our thinking, and it helps us think sharper, and oftentimes better and more clearer. So let's jump right into it. So we've already talked a little bit about technical analysis from a very, very high level, but y'all do something called relative strength investing. Could you tell us a little bit about what is relative strength, and how does it differ from maybe some other investment philosophies out there?
Yeah, absolutely. So the relative strength. So when we say relative strength, you can almost think of it as being like synonymous with the term momentum
Okay.
investing. So it's kind of our application of momentum investing, how we arrive at identifying momentum areas. So momentum's one of your classic investment factors. You have value investing, you have growth investing, there's momentum, and some others as well. But basically, what what we're trying to do with relative strength is identify leaders in the marketplace, whatever areas are leading the price movement, taking prices continuing with upwards momentum, right? Continuing to move higher, identifying leaders, maintain exposure to those leaders until they're no longer leaders, until they're losers. And then we sell those and move into whatever is the new leader. Is at the end of the day, kind of what the momentum factor is trying to do. Hold
Okay.
on to winners as long as possible. When they become losers, you sell it and you buy whatever is the new winner.
Okay. Now we had a conversation offline, and you used a really interesting analogy for relative strength investing. And I know it's not March Madness time, but I think most people listening here will track this analogy of during March Madness, right? You're picking your brackets. You're trying to pick who's going to win the tournament. And I forget the statistics. I'm sure you can tell me. Statistically, the top seeds win the tournament because they're the teams that are winning, right?
Right. Yeah. So when you're picking, everyone wants a Cinderella story, right? Everyone wants to pick the 16 seed that goes on to win the tournament, and you get a one time in the life to kind of do that type of deal. But when you look at it historically, the March Madness tournament, when you just look at it by number of games won, the first seed has almost an 80% winning percentage. If it's playing a game, if the first seed is playing a game in the tournament, no matter if it's the first round or the fourth round, if it's playing a game and has an 80% chance it's going to win that game, right? First through third seeds are at about a 72% winning percentage. So the higher seeded teams have proven historically that they're more likely to win the games in the tournament. On the flip side, the lower seeded, so 14 through 16, they're at about an 8% winning percentage historically. Granted, most of the times they lose in the first round, so they don't have as many times to play, so the percentage is a little bit, you can certainly think about it like that. But when you just look at the teams are seeded for a reason. They put in the work. They've won the games throughout the season. They've shown the best chance of continuing to win. So they're ranked higher, and then they continue to win, typically more than the other seeds in the tournament. And we think about our relative strength approach in a similar fashion. We're looking to pick the winners. We're looking to pick the names that have shown the most potential for further outperformance by indicating they've outperformed so far. And so we're looking to capture exposure to those areas as long as possible.
So, okay, so let's pull back the curtains a little bit. You said we want to identify the winners. In basketball, it's easy, right? To identify the winners are identified for us with the seeding. But in the investment world, you've got, I don't know how many thousands of options to pick from. And there's multiple metrics to choose from. So how do you identify which ones are the winners? What metrics are you using?
Yeah, so we use relative strength investing, RSI, is something that we by no means did we originate, or we're the only ones that utilize, but we use it in a slightly different fashion. So when I say RSI, it's essentially taking the price movement of two things. Let's say two stocks. Let's just say Apple and Microsoft, right? Or any two names, stock A, stock B. We take stock A, we divide it by stock B. That gives us a number, or a ratio, basically, of how that price has changed over time. If that ratio is moving higher, then stock A is outperforming stock B. The ratio is moving lower, then stock B is outperforming, and that's the place you want to be in. We then apply that on a chart. We got point and figure charting. I won't get into the nuts and bolts or the X's and O's of point and figure charting, just for the sake of time. But it basically gets us a way to identify buy points and sell points in that relationship. Which area is in favor, stock A or stock B, and then we maintain exposure to the area and when it's in favor until it moves out of favor. So you can think of that like comparison between two names, kind of like a sports game, right? We just stack stock A up against stock B in a game, and we see which one wins that game right now. And then our broader comparison, you mentioned there's thousands of different securities out there, right? But if we want to look at different areas together, then we just simply take stock A and compare it against stock B, C, D, E, F, on and down the list, and see, okay, how many times does it win each of those games? And then we compare every other stock against every other name in that inventory and basically get an aggregated win total for each of the securities. And that gets us to like a win-loss record for the stock relative to its peers.
Okay, so let's walk through an example here.
Sorry.
Yeah, no, that's good. So let's just walk through an example. So you have multiple portfolios that y'all manage over there. So you might have a portfolio manager who says, hey, this portfolio, we want to invest in, let's just say, large cap companies, right? So now we all of a sudden take our world of stocks that we can buy and we just shrunk it down to large cap based off of some market capitalization number, whatever that number is, okay? And then from there, are you further kind of categorized and saying, hey, we want to hold, does it matter to you in terms of like, we want to hold so much of one particular industry or one particular category? So we want to hold 25% in technology or 40% in technology, or does that not matter to you? And then within that particular industry, you're comparing what it sounds like you're comparing one name to all the names that are available in that category, or you comparing names to all stocks in the larger category. Does that make sense? So I'm not just comparing Apple to other large tech. I'm comparing Apple to other large cap American firms.
Right. So, I mean, so to answer the question on the constraints, I mean, at the end of the day, you can certainly do that, but we're not going to do that at the first level. You would kind of add that stuff in after the fact. To generate the ranking, we're just going to compare Apple against every other name in the inventory. Let's say we're doing the 30 members of the Dow, right?
Okay.
We compare Apple against 29 other stocks. How many times does Apple indicate a buy signal? How many times does it get that win? And it could be any number between 0 and 29, right? We do the same thing with Microsoft, same thing with Salesforce, same thing with every other name in the Dow, and see, okay, how many times does each of those names get that win? And then we just rank them by the wins, basically. And then if you want to add over a sector constraint, or you want to say, hey, I don't want to be more than X amount in technology or consumer discretionary, whatever your sector is, you can add in that after the fact. But first you need to kind of generate that ranking first, and then you can take that ranking and apply it to different strategies.
So in relative strength investing, or the way y'all apply it, is there any element of like, okay, here's the 100 names that we have identified as these companies are winners. but we only want to hold 50 names. Do you continue to compare them using relative strength techniques, or at that point, do you apply maybe some fundamental analysis and maybe pick what y'all feel or think are better companies based off of some more fundamental metrics?
Right. So typically we're going to be looking at it. It depends on the kind of the strategy that's imposed. So when we're looking at that multi-stock comparison or multi-security comparison, kind of like we're talking about, we call that a relative strength matrix, right? It's just creating a matrix of those comparisons to stack up against one another. When we're doing something like that, we don't want to hold everything in there because some stuff is ranked high, some stuff's ranked low. So we'll pick the top end of the matrix, typically like the top decile or the top quartile to purchase. And then we have a pinpointed sell threshold in the ranking that's saying, hey, if we buy the security, it's in the top 10, let's say. If it falls in the bottom half, we sell it, we buy whatever is the next highest ranked thing that we wouldn't already own. So that's one way that we kind of apply that comparison. And then that's where you can get into some of the different like sector breakdowns. If you want to say, okay, I want to buy the top 10, but I only want to hold 3 tech stocks at max, right?
Okay.
Then you can say, okay, if I meet my top 3 tech stocks, I'm going to start, maybe I go to the 11th or the 12th name because I've maxed out my tech position, that kind of deal. There's other ways to do it where you can kind of Z-score the rankings, and then you can apply that across a broader inventory if you want to.
What do you mean by Z-score?
It's just kind of aggregating a score across all of them.
Okay.
So it's a similar concept, but just kind of normalizing a scoring after the comparisons are run. And then that can allow you to kind of pinpoint a target list of 50 or 100 to look toward.
Now, when you're comparing names, is there a particular time frame that y'all use to identify winners? Is it over a 6-month period, a year period, 5 years, or like a rolling time period that you find most effective for relative strength?
Yeah, it depends on what you're comparing on a relative strength basis. So we're not going to define a particular time frame. Your classic momentum approach is 12 minus 1, right? You take the past 12 months of performance, subtract the last month of performance, and see, okay, over the prior 11 months, what was the best performing stuff? And that's the stuff you own. Our approach is a little bit different because it looks at these relative strength comparisons to identify which areas have the best momentum. And something could have not good momentum for 6, 7, 8 months, and then all of a sudden it pops up and then it has great momentum moving forward, right? So we're going to be able to capture not necessarily over a defined time frame, but whatever's the most important move to that price relationship and capture those securities moving forward. So the way that we would look at it is essentially if you're looking at the charts that we're looking at for these relative strength comparisons, we can adjust the scales to pertain to different time frames. You can think of it like zooming in or zooming out on the chart. Basically, it comes down to you want to generate kind of consistent movement over time. And so you don't want to look at something super short term trading every day if you only want to make trades every month, right?
Yeah.
You can kind of adjust the scale to better cater to the approach you're looking to capitalize on.
So what would you say are the main, because I mean, we talked about that there's multiple ways to evaluate companies and multiple ways to build portfolios. What would you say is the main advantage of relative strength investing?
There are 2 main things, I guess I would say. The first is that it's objective. I mean, you can cover up the names on our kind of rankings or charts, cover up the names of whatever it is you're looking at, just stock A, stock B, look at the chart and get a feel for, okay, which one is the better investment right now? Which one should I be in? You don't have to know anything about the fundamentals of the company necessarily. You can just get an objective view just based upon the price movement, which one looks like a better play right now. So it's completely objective. You don't get the kind of thoughts in the pit of your stomach coming into play if you're going to be purchasing something and swapping it for something else. I think that's a pretty important thing to keep in mind, especially in the modern environment. The constant flow of information that we're going to be getting about every company, right?
Yeah.
Maintaining an objective point of view is pretty hard these days. And so kind of like cutting through the noise that you get through with the news cycle, I think can be pretty helpful. That would be the first one. The second one would be it's systematic. So it's kind of in relation to that. This is something that's rules based. It's not that myself and the other members of the research team or our portfolio manager sitting there saying, hey, we think Apple's a better buy than Microsoft right now, right? It's using that objective rankings to just let them systematically run as they should, and we're not going to go in and tamper with it. It might not feel great if you're selling one name that's been a winner for a while, but if the price movement has shown that it's no longer a winner, you got to sell it and move into something else. And so the maintaining an objective point of view and then having a systematic approach and something to fall back on. I mean, we've been through 2 bear markets in a 3-year span. It's not all that frequent that you really see that much turbulence in the marketplace. And so having a system to fall back on, I think, is a pretty important thing to keep in mind too. When you get in that choppy, uncertain environment, you got to have something to turn back to and say, okay, what should I do moving forward? And RS provides a pretty good backbone to keep you in play.
Yeah, what's interesting about those two strengths, the 2 advantages, is they both remove emotions from the equation.
Yeah.
And if there's anything that causes poor poor investment decisions, it's emotions. In fact, the episode that is published just before this one here, and people listen to, is called "Should I Adjust My Portfolio? The Emotions of Investing," where I talked to a friend of mine who's a couples counselor, a therapist, and we discussed the emotions of investing. And pretty interesting how emotions are our biggest nemesis to long-term performance in our investment portfolios.
Oh yeah.
So go ahead.
No, I was going to say, we see that play out all the time. I mean, we have a lot of different kind of ways we apply relative strength concepts to securities on our research platform or in our strategies. But if something moves from a strong rating to a weak rating, we get calls from advisors all the time. Are you sure? Are you sure? Are you sure it's to sell this? Are you sure it should do this? And we're like, hey, cover up the name. What should you do? Right. And that's and more often than not, we see that removing that emotional aspect definitely turns out into more profitable trading.
Do you ever do that with your team? Do you ever just kind of like get a list of companies just for the exercise of it, and have no idea what you're investing in? Just
that's and we don't do it and actually invest in it. We definitely do it when we're training people, but it would be pretty interesting just to have a list of names and just blindly have a hypothetical portfolio run that way.
I think y'all should launch a brand new portfolio that does not look at any, like, none of the analysts ever know what they're investing in, that you scrub the names of the companies for your analysts, and you just build a portfolio off of that, and you don't have to just kind of run it to see how it performs against the other.
Yeah, all we'll show is price. That'll be pretty interesting.
That would be fascinating. So, okay, so we talked about the two advantages of the objectivity, and it's systematic, removing the emotions. What would be some of the limitations that you would say of relative strength investing?
Yeah, so the biggest hurdle for relative strength is when it's really not going to be as helpful, is when everything's moving in the same direction. So if you get a market environment where we're comparing things relative to one another, if everything's heading down or everything's heading up, it's hard to kind of discern what to buy because everything's moving the same, right? And so that's where the relative strength can be difficult. Typically, those environments don't tend to last for a super long period of time. But when everything's heading in the same direction, or controversially, when there's not a clear trend, when you get into like a choppy environment, I mean, relative strength or momentum investing, at the end of the day, it's trying to capture trends in the marketplace, right? And so if everything's trending the same way, or there's no discernible trend, then relative strength's not going to be as great moving forward. Going back to the benefits, though, I will say that those environments, A, they typically don't persist for prolonged periods of time, and B, having a systematic way to stay self-correcting, I think, is very, very important in those environments too. But yeah, those would be the 2 areas that if you don't have the clear trend to kind of capture, then that's where relative strength strategies typically struggle.
So talk to us about relative strength in today's environment. So what we're kind of seeing right now, there seems to be a rotating of money out of maybe larger tech in particular, kind of maybe that money's being spread out more evenly across the market. So how does relative strength work in this environment?
Yeah, so relative strength just went through one of its longest stretches of underperformance in history. From 2022 through the first half of 2023, it was a pretty rough 18 months for momentum in general. whether you look at our stuff, whether you look at other people's momentum approaches, it was just hard to follow the trends. There weren't really discernible trends. It was a real choppy market environment. It's hard for relative strength to really show alpha or show outperformance in an environment like that. We bounced back pretty hard starting in the fourth quarter of last year, and momentum investing really came back into vogue, I would say. It started doing pretty well. You had the clear leadership from technology, large cap, mega cap, your Mag 7 names, right?
Mm-hmm.
Kind of leading the market higher, and momentum was able to capture onto those areas. Those names kept moving higher. And so as long as they kept moving higher, your momentum strategies generally tended to do pretty well. Recently, that's gone under a little bit of more uncertainty. But it's not like we're seeing the large cap areas fall completely out of bed, right? You can't have names go up into the right forever. And so when you get into a little bit of underperformance, I would say a benefit that we are seeing is that you're not really seeing a lot of other areas be carried lower with the movement that we've seen over the past few weeks. I mean, I don't know if we can mention individual names or recent performance on here, but you had some of the bigger stocks were down quite a bit earlier in August. And we didn't see a lack of participation from the broader market. Everything else wasn't necessarily completely falling out of bed like you might have expected.
Yeah.
And so at the end of the day, that's probably a good thing. I mean, as much as we would like to have everything go up into the right forever, having a correction can ultimately lead to further improvement if we get that bounce back down the road.
So how hard is it for you guys when you see, I don't know, maybe some wild swings in the market, right? Where trends sometimes move fast, sometimes they don't. But when you have a trend that moves fast, like how do you keep up with it? And is there a temptation? You have to fight the temptation to make big changes across the portfolio?
Oh yeah, absolutely. Well, I mean, I guess we don't have to fight the temptation because of the systematic way that we're running it, but it doesn't feel great a lot of times when we're looking at some of these moves. We've a variety of different ways we apply relative strength on our research platform. Some of those rankings move pretty quick, and some of them are meant to be more higher level, more slower moving, right?
Mm-hmm.
And when we look at the historical performance of which rankings do best over time, what we've seen typically is that more trading typically does not lead to better performance. Trying to capture those trends quicker typically doesn't lead to better performance over time. You want to stay in, I mean, we're looking for the meat of the move. So whether you catch it at the absolute bottom or you sell it at the absolute top, at the end of the day, is not as important as getting the right trade, right? Making sure that you're getting in the right area. And so a lot of times it's trying to take a step back from those really quick, sharp moves and just maintaining a little bit of trying to be an objective approach and look at it from a bigger picture perspective. And so, I mean, this one day is not necessarily going to blow everything up, even though if it feels like that in a few hours. But it's staying with that longer term focus, I guess, over time is what we're trying to typically do.
So talk to me a little bit about, I imagine in relative strength investing, there's a little bit more turnover in your portfolio. So turnover, for those of you listening who might not know what that means, is the percentage of your portfolio that's changed throughout the year. So, a portfolio that has 25% turnover, the names that you own are 25% different by the end of the year, or the positions are 25% different. So I would imagine that maybe there's a little bit more turnover in relative strength investing. Is that the case? Is that one of the things that you need to be conscious of as a research team?
It can be, but it definitely depends on where you're applying relative strength, right? So if we're looking at area, like let's say we're looking at the Nasdaq 100, right? Those 100 large cap growth oriented names, they move pretty quick. And so if we're looking to apply relative strength to that basket, we might get a lot more trades than something like the 30 members of the Dow, right? They don't move as quick. We don't see as much turnover there, but generally, I mean, you'll be looking at more trades. But what we've done a lot of testing recently on a variety of our different models or portfolios, and looking at what those trades do to the portfolio over time. So most trades and most relative strength models are actually not profitable. You get most of the profits from a small subset of trades that are held for a very long period of time. That's where the most of the outperformance comes. Most of the other trades are occurring typically within a calendar year. And so relative strength tends to be pretty tax efficient because you get to sell those losers, and then you get to kind of offset some of those longer term capital gains with the more near-term losers that you'll be rotating out of. So it generally, while it might be a little bit more turnover, that those trades tend to be a little bit more tax efficient than some other approaches.
Yeah, let's sit on that really quick. I want to talk about what you just mentioned because I think it's really important. He said sell the losers, so that's a strategy, tax loss harvesting, right? Where when you hold individual securities as an investor, you're able to sell the losers, and that offsets any potential gain. So I think that's an interesting thing, and I'm glad you mentioned that because that wasn't even on my radar to talk
It's
about that.
it's definitely. I mean, we've run this across many different models, many different strategies that we have, and it's funny. You see on there sometimes you hold a security for 10, 12, 15 quarters, right? And that's could get you a lot more alpha in the portfolio than maybe a trade that you held for 6 months, right? And so you're looking to try to capitalize on those long-term losers, or try to capitalize on the long-term winners. And then, like I mentioned before, the strategy is self-correcting. So if it buys something that's not a winner, it'll just sell it and try to buy the next thing that it could be a winner over time. So that's where you get those near-term losers that it can shell out.
So I'm curious to know. We've talked about, you mentioned 2 bear markets in 3 years. We have bull markets, we have bear markets. Do you find that that relative strength, and maybe it's both but relative strength outperforms on the upside in bull markets, or it outperforms on the downside in bear markets? So in other words, when things are down, relative strength tends to be down less, or when things are up, relative strength tends to be up more.
I mean, it's everyone's favorite answer. It depends.
Depends. Yeah.
But no, it does. I mean, so you see both is really the answer, because it depends on kind of what you're looking toward. If you're looking at a bear market environment and you're trying to run relative strengths and maybe a small cap approach, probably not going to be great, right? But if you're just looking at kind of broader market deals, the relative strength is not going to, it's not going to sell at the top, and it's not going to buy at the bottom. You need some indication of a change occurring in order for it to capitalize on that trend change. And so there's inherently going to be a lag, right? We're going to try to catch the meat of that move. And so if you get into an environment like the pandemic, where you go straight down and straight back up, it's difficult for most relative strength-based approaches to really capitalize on something like that because it's so quick.
Yeah.
If you get into a more of a prolonged bear market environment where there's more kind of price indication of changes occurring, then it can be better over time. On the flip side, if you have something, the start of bear bull markets, I guess, would be difficult in either direction because, like I said, everything's moving the same way. But once you let the signals kind of play itself out, that's where you can see the importance of relative strength come back into the coin.
So it sounds to me like y'all are managing a lot of data. So I mean, I imagine the research in a technical firm like yours is pretty. I mean, you got a lot of stuff moving through. How have you seen AI maybe impact y'all's process, or is it, or where do you see AI helping you in the future in terms of making some of these decisions?
I think, I mean, that's an interesting question. Derek, you're not the first person to ask us when's the Dorsey Wright AI coming out, or what's going there, right? I mean, I think artificial intelligence is something that's not a new phenomenon. Even though we just got into the large language models over the past few years, artificial intelligence is not new. And in a way, we've kind of been running a semblance of artificial intelligence for years, right? We're letting the computer kind of dictate the trades that we should be in over time, right? Do we have all of the trades plugged into a large LLM on the system? We don't do that. We don't have that data panned out. But I think that one of the benefits of artificial intelligence and what people really like about it is some of the same things, some of the benefits of relative strength and kind of momentum investing. It's systematic. It's objective. The computer doesn't care kind of what you should say, unless you tell it to care through prompt engineering, right? But at the end of the day, it's that systematic approach that I think plays in well. One thing that for our specific approach, where we've started implementing some AI approaches, is to better communicate and get at what people are looking for quicker. And so on our research platform, we have a variety of ways that people can like screen through securities. So trying to streamline the evaluation process I think is something that artificial intelligence can definitely play a role in. It can get you at the answer quicker than doing it yourself. That's definitely going to be a big benefit of it. But that would be the main way that we're looking to apply it right now.
Yeah, two things you said that are interesting. So I'll start with the last one you said in terms of getting to your answer quicker. And that's the benefit, right, of AI. It can process data a lot faster than you or I can on our own. But the other thing that I think is really interesting is that in some way, shape, or form, AI has already been playing a role in some of this stuff. I mean, all AI really is. I mean, it's just advanced filters that can think on their own through some prompting, right? But you've been filtering massive amount of data already through multiple systems and multiple platforms for a while. So it's not necessarily like, oh, this is going to revolutionize how we do stock picking. It's just make it a
Yeah,
little bit
yeah.
faster.
Yeah, faster would probably be the best thing. And it's not, I mean, yeah, we've always run things kind of objectively and systematically. So it's not going to change the way that we're doing things from a decision-making standpoint. It might just make those decisions happen quicker. I am pretty curious to see how it affects the broader market movement, though, just tangentially. I think that if everyone's able to make decisions and trades quicker, what's that going to do to the broader market movement moving forward? I mean, are those we're going to get more kind of V-shaped moves moving forward, or does it kind of take a step back and it's if it looks past movement like that, right? As hey, this even though we're down 10% over the past month, at the end of the day, that's typically not that big of a deal. So if it's an algorithm-based deal, does it keep us rolling? I think that'll be a pretty interesting thing to see play out.
That is fascinating because when we look at the biggest impact on performance, it's investor behavior, it's investor
Right.
emotion. But if we totally remove that, or if we remove that from the majority of the market, it's a really interesting point because a lot of the big drops that we see, it's Warren Buffett sells something and someone sees that big trade, and then someone has a program that's supposed to sell if a stock drops by a certain percentage, and then they sell, and that triggers someone else's sell, and then it's just kind of this snowball effect. But if we like take that completely out of the calculus, right? Like that's interesting.
And so I think that brings up an interesting point, though. I don't know if it would be removing it from the calculus, because when you think about these large language models, they're built on prior information. So all the
Mhm.
information they're going to be built on is all of the prior individual decision making that went into those trades in the
So
past.
we basically have taught it our bad habits.
Is it just going to amplify the bad? I don't know. We'll see
It
what
depends on
sticks out.
whose behavior we train it on.
Right, right. If you train it on mine, maybe not the best, but
Oh my gosh. So I don't think we're gonna have an answer to this. But all right, I'm gonna put you on the spot. Okay. Um, are you like, I am sold out on relative strength investing? This is the only way to invest, or do you recognize, hey, there is some benefit to value investing. They're not all wrong. You can make money doing value investing or other stuff.
absolutely. I mean, that's going back to the probably the first question you asked me. If you would have asked me 10, 15 years ago, are you sold out? Then yeah, absolutely. There's no other way to invest. But there's pros and cons of each, right? I
Yeah.
mean, like I just mentioned, we just went through a really bad cycle for momentum. And so throughout that time, we had rankings that show, you know what, the way that we look at momentum, we have momentum rankings of factors that show that momentum was not doing well. So
It's
you can kind of look at it and say there's other areas to be. Tom Dorsey, one of the founders of the firm, used to always he talked about it as playing the piano with both hands, right? You want to have the technical side, the relative strength side of the coin, and you want to have a more fundamental or additional analysis to factor in as well. You can play a lot better tune when you use both hands of the piano than just one.
good. That's awesome. Well, man, this was good. Is there anything that you want to add to the conversation? Any other piece of wisdom you want to drop for us, or
No, I think yeah. Thanks for having me on. If anyone wants any kind of further information on Dorsey Wright in general, you can definitely just Google us or plug us into whatever large language model you're looking to find us on, and we can get you contact information there.
Yeah, y'all, thanks for listening. I think this is I think if there's a takeaway here, it's that I mean, we are talking about one style, one philosophy of investing. So if you are doing it on your own and you're buying a mutual fund, or you're buying an ETF out there, it's important to understand what's going into the philosophy of picking those companies, because the last thing you want to do, um, is sell a manager who is doing what's expected to do in that particular market. You want to hold managers through market cycles. That's a big disservice that you do to portfolio managers when you don't understand their philosophy, and understand how they invest and where you are in the business cycle. So, Ian, man, thanks for taking time today and sharing with us. Appreciate it.
Absolutely. Thank you for having me on.